Good morning. This is Jared with the Helton Group, and today we're going to be lending some knowledge of what's going on in the market on the 3rd of February. And the news is quite a bit of news this week, actually. So we had the Fed raised interest rates, which kind of everyone expected. They raised them up 0.25%. That's usually inverted. Sometimes it goes along the same way, but mortgage rates actually got better that day, which is great. The initial jobless rate release came out and it kind of fell, which was good also for the mortgage market. Mortgage applications fell a little bit last week. And then the big one was the Bureau of Labor Statistics job came out today, and it was much better than what people thought in job creations. But as with anything, there's a little bit more information to this. So when you look at it and you kind of break it down, is you had a lot more job growth. So it's 894,000 jobs, but of those, 606,000 of them are part-time. So it's not really real jobs or livable wage jobs. It's like someone getting a second job or a third job or those type of things. And then also they changed how they look at the methodology of it. So they had 894,000 people, but 810 of them were this thing called population control effect. So it's not, which is that's not how they used to do it. So it's kind of, the numbers are kind of funky. They don't all, seem right, but there is what it is. They're going to present whatever they want to present. But I think once the market kind of reacted negatively to this, I'm hoping the market kind of bounces back later today on it. But currently it's probably off a little bit from this. So what that looks like on getting interest rates. So when we look at the sample, last 30 days, they've been coming down, which is great. Last 2 years, certainly, higher than what they've been, but good trajectory down. Same thing with the 5-year. And then if you look at the loan scenario, which is putting 20% down on a vanilla kind of loan. So what you have on that is the same rate week over week. You got a $2,342 payment for 20% down loan. And then it gives you the same buying power week over week, but up $18,000 from last month. And then if you look at buying up or buying down interest rates, using that 5.99, you could go up slightly in interest rate and get a credit. You wouldn't want to go up just an eighth. You want to go up 3/8 because that's kind of better bang for your buck. You get a credit of $1,500. It costs you $80 a month. So the break-even period is 19 months. So you probably wouldn't do that. And then when it comes to buying down the rate of interest, you wouldn't just do 1/8% because the break-even period is 97 months. You'd want to go all the way down to 5.65, which is nice to see we can do that again. And the break-even period on that is still 31 months. I don't know if I would do that, but it's something that people could do if they have a psychological, like they'd like to get below, that low, mid-5 number, which is possible. So, and then what we got going on for our little trivia each week. If you've been, if you've ever been to the dentist in the 80s or 90s, you certainly probably heard this. We built this city by Starship, and the rates then in 1985 were 11.64%. So quite a bit higher than what they are today. But again, if you ever have any questions over the weekend, feel free to reach out. We're here for you. We'd love to help, and we'll talk to you later. Thanks for watching.